All right, we are live. Thank you for joining us, Dion and Sean. Really appreciate it. We've got probably, I think, just over 500 people registered. So,
Wow.
as always, let's just give it a few minutes as people trickle in.
Sure.
But yeah, I mean, before we get started, just really, really excited to have you guys. I appreciate it.
Likewise.
Dion, I've been watching your webinars and your presentations for some time now, so it's great to
Great.
have you on as a guest.
Yeah. Happy to be here. I don't know too many people who show people how to build a $100 million portfolio. So this should be fun.
Well, that's why I love doing this because, first of all, it's a 40 million, but in my lifetime, for all of the reasons you're going to talk about, the principles of investing over a long period of time, I will see $100 million portfolio, probably hundreds of millions of dollars. I guess as people come in, I'll just do a little bit of housekeeping. We are going to be recording this. So, we'd love for you guys to stick around and ask questions, but if you've got to run out and put the kids to sleep or do whatever you need to do, don't worry, we're going to send an email out tomorrow with all the information. For those of you that have tuned in, this is going to be an absolutely incredible webinar. I'm not just saying that because I'm on it. I've got two incredible guests. You've got 60 plus years of real estate investing, real estate experience on this webinar. As I mentioned before, Dion, I've watched your webinars, your presentations. You really know your stuff. You're one of the top brokers, mortgage brokers in Canada. You come from an investment planner background, and we connect. We take an investment advisor approach to selling real estate. So you talk our language. Really excited to hear what you have to say. Sean, VP at Rad Marketing, $6 billion in pre-con sales, a heck of a lot more than me. Wow. And a lot of, our clients have made a lot of money investing in the projects you represent. So really excited to hear what you have to say about Hamilton. And, before we kick off, I wanted to share a quote with you guys. I'm a big fan of Rich Dad, Poor Dad. Robert Kiyosaki is the author and teacher of Rich Dad, Poor Dad. And this quote is, "The number one reason people fail is because they listen to their friends, family, and neighbors." And what he means by that is, if you want to become successful at something, you should probably listen to the people that have the success that you want to achieve yourself. And, that's why I'm really excited to have these speakers. And I think we're going to add an incredible amount of value and education to everyone who sticks around because, we've done that. We are the experts. We've got the experience. We've got the wins. We've got the losses. And you guys are going to learn a lot. I think it's also important today to mention that in today's market that with the media as negative as it is, everyone all of a sudden becomes an expert. So follow the people that really know what they're talking about. If you guys don't mind, I'm going to jump right in. So Connect Group of Companies, I'm Ryan Coyle, broker owner. Connect.ca Realty is our brokerage. We do resale, we do pre-construction. We work with investors, we work with end users, help them find their dream homes. We do all of that. Canadian Real Estate Wealth is a media channel that provides up-to-date information on real estate market trends. Marco Toronto is a property management company I acquired in 2019. It was really a means for me to help manage my portfolio, but I wanted to take some of my unfurnished condo units and furnish them and try to increase my ROI. I had a lot of success doing that, so I bought the company so I could do that for our clients. Now we have a couple hundred, I think we have about 300 units under management now, mainly our Connect clients. One Day Money is a private lending division that we started 2019 that allows investors to tap into the equity of their pre-construction investments. So you buy a condo 5 years ago, for example, 500,000, it's worth 800 today. We would lend based on today's value, so you could tap in your equity to help close or pull out equity. One Day Assignments is a division that we have that helps people liquidate their assignments when there's enough equity to do so. So the agenda, let's jump right in. So Dion is going to kick this thing off. Again, really, really happy to have you here. I've been watching you for a while. We share a lot of the same views and principles in investing in real estate. You're going to talk about why real estate is the right asset class, the interest rate journey. Everyone wants to know what the heck has happened over the last few years, what's going to happen over the next 6 months, 12 months, 24 months. So can't wait to hear your insight on that. Strategic financing, really, really important if you're scaling a portfolio. And then the compound effect. This we talked about, I saw your presentation before, and I'm so aligned on this. This is really the magic of real estate investing over a long period of time and how people create serious wealth. And then I'm going to talk about why pre-construction condos. So I've accumulated a $40 million portfolio mainly through investing in pre-construction. So I'll get into why pre-construction as the real estate asset class, the investor operating system, the 4 pillars that Dion is going to talk about. I will talk about how they apply to pre-construction. It's the easiest way to scale a real estate portfolio. I could not have done it through other real estate asset classes. I'll talk all about that. I'll talk about the multiplier effect, buy, rent, refi, and repeat, and essentially what I've done to accumulate my portfolio. And then I'm an open book. I'm going to show you guys my portfolio. If you guys want to poke holes in it, ask me questions. I'm going to show you what it's worth today, and I'm going to show you what I think it's going to be worth in the future. And then Sean is going to, talk to us about Slate Asset Management. Look, this webinar came together because there's an incredible opportunity to invest in Hamilton and in Corktown Condos, which is a project in Hamilton. And I'm investing in it. We're really excited to talk about it. Sean will talk about Slate Asset Management, the developer, Hamilton growth story, which I'm obviously very excited about. I know you do a lot of business in Hamilton as well, Dion. Corktown Condos, and an exclusive insider opportunity. So hopefully you guys stick around. If not, we'll send out the info tomorrow. And then I'm going to look at financial forecasts. So I bought a unit in this development. I'm going to show you exactly what I look at when making a decision to buy a off plan, essentially, and make an investment. And then why I'm adding Corktown to my portfolio. And then we'll do a Q&A. Dion, I'll let you do the long introduction of yourself and take it away.
Oh, sure. You know what? We can skip that because some of that's covered in my presentation. So I'll just jump in.
Cool. I know you want to move over and do your own screen share. So go ahead and take over.
Yep. So let me just try and do that.
It was a bit weird presenting without seeing myself. So everyone's still there? Sean, yes. Yeah, I see you there.
Yes, absolutely, yeah.
Okay, I think we're good to go. So I could have named this topic, this presentation, anything, but I decided to name it Pandemics, Pricing, and the Path Ahead, which is really what we're going to talk about today. Now, the big question for you that I want to ask before we start today is simply this. Do you believe in the future of Canadian real estate? And I do, and I know Ryan and Sean do, quite simply because we all believe that history has a tendency to repeat itself, and more so when the supply and demand equation is so tilted in such a way as it is today, with immigration at over 1 million a year and supply ever dwindling. This is the 40-year history on which I base decisions for myself, my family, my clients. And I know that we're going through a turbulent time right now, but this is the belief that I have in the future, in that what we have seen in the past will continue. And this is what I know to be true. Asset holders, not savers, will be the ones who are able to protect and grow their wealth now and in the future. So you're here today to hear about real estate, but let me tell you, I know you're not really interested in the real estate. And I know this because I've been in this business long enough to know that beyond the bricks and mortar, the floor plan, and the finishings, after that's all done, you're interested in 3 big questions as to how real estate will impact you and your life. Those things are, how will real estate help me get debt-free? And we show people how to get debt-free in 10 years. How will real estate help my children? And in terms of 2 key things, education for my children and their own entry into real estate. And finally, retirement. Now, I don't know, I haven't come across a person who couldn't deal with an extra $2 million in retirement. And most of our clients are millionaires, multimillionaires, or well and truly on their way to being that by retirement. And the funny thing is, almost none of them come from what you would call the top 1%. Most of them are middle-class Canadians who have just decided that they're going to treat these 3 questions with a level of seriousness that other people just don't. Now, I'm happy to say that along the way, we've helped literally thousands of people. If ever you want to visit our website, you'll see dozens of video testimonials. And we've got now over 400 Google reviews. We've funded over $1 billion in mortgages. And I've been lucky enough to be ranked in the top 75 brokers for the last 5 years consecutively. And it really is because as a mortgage broker, I've chosen to help people get wealthy, to help people solve those big problems. And there's another thing that you should be highly aware of right now. And if you've felt this, especially in the last year, what I'm about to tell you is it's true. There is an ever-growing divide between those people who have and who have not, right? And the reality is, if you don't take action, the status quo will not be enough. This is what, again, I know to be true. And this is what I want you to know. More than 1 in 10 homeowners in Canada own multiple properties. That's 10%, okay? In the GTA, it's actually 13%. And so most of my clients, well, my clients fall into that category because they're owning more than one. And the thing is, a lot of us, when we look at the top 1% in the world, we'll say, we'll never be part of that. And you know what? That's probably true. But I would say to anybody who is listening here today that you should make it a worthy goal to attempt to be in the top 10%. And not just for you, but for your kids. This is a headline from yesterday, okay? Adult children of homeowners are twice as likely to own a home. Okay, this was a survey of people born in the 1990s. They're now adults in their 30s. And what they found is that people who had parents who did not own any property, only 8% of them are property owners today. But people whose parents own 3 or more properties, 27% of those 30-year-olds own properties today. And if you were to ask me why is that, it's because these parents have no problem writing a check to their child for $500,000 because it doesn't impact their own retirement. They can help their children get a leg up into real estate, and they do that from a foundation of strength in property ownership. So as I'm presenting this info to you today, I want you to continue to ask yourself this one question. Am I doing the best I can with what I have? All of us have 2 things. We all know we have money, but the thing we forget about is time. And 10 or 20 years investing in the wrong asset class is the difference between ending up with an extra 200 grand at retirement or $2 million at retirement. And if you listen carefully, you will probably start to ask yourself this question, or say this to yourself, as many of my clients say this to me every week: Dion, if I had known this 10 years ago, I'd be a millionaire today. I can't take you back in time, but you can look forward to the next 10 years. And your next 10 years depend on the decisions you make this year, right? So let's take a look at this journey through time, okay? We're going to talk about today, but to do that, we first have to go back, look at a little bit of history, and then we'll look at the future and how, that will dictate the action that you should take. So let's take a look at the big drivers that have brought us to where we are today. Inflation and interest rates, okay? The 2 big drivers, they're tied at the hip, as well as housing supply and demand. They're the big drivers driving our property market right now. We all know the interest rate journey. It's gone up and up and up. It's ugly to look at, okay? But we've raised basically 4.75% in the last 20 months, okay? I want to also remind you, this is the 29-year graph, that we've been on this journey before. And while we've had these ups and downs, that's 2008. That's the end of the world global financial crisis. When you look at it on a time horizon like this, it's a blip, right? This is 2017, introduction of the foreign buyers tax. And this is where we are right now, okay? I'm less interested in the blue line. I'm more interested in the orange line. And that's where you guys should be focused as well. And the orange line tells us we're kind of back on trend. So let's take a look at what happened during 2020, 2021. It wasn't that long ago that the government turned on the money printer. 30% of all the dollars that exist in the Canadian economy today were printed into existence since March 2020. Okay, this was through CERB and CEBA and all those government plans that help people stay in their homes and make their payments, so that effectively the economy kept on running. It was necessary. It happened in our country and many other developed nations. So it's not just us, and it wasn't any particular government or brand of government. It was needed. Now in 2020, July, this is what the Bank of Canada announced to the nation, word for word, verbatim. if you've got a mortgage, or if you're considering making a major purchase, or you're a business and you're considering making an investment, you can be confident rates will be low for a long time. Okay? This was directly from the mouth of Tiff Macklem. And when Canadians heard this, you could then seconds later hear this. Piggy banks all across the nation just getting smashed and saying, hey, we've been given permission to go and invest and go and buy. Okay? Then this happened, this massive surge in pricing. Okay? You were all witness to it, you were all party to it, and many of you benefited from that period of time. Then 20 months later, Mr. Macklem comes out and says, you know what? We actually need higher rates. So apparently a very long time for the Bank of Canada is 20 months. And I think we were all surprised and somewhat disappointed that we were led to believe that we were going into an economic climate that would be that way for many, many years. And as it turns out, it was less than 2 years. So quantitative tightening was the focus now. Now, if you want to visualize what quantitative tightening is, it's like this. I want you to imagine that you're driving this car down this road, and probably somewhere over here, that's where you and I would tap the brakes, right? We know we're going into a hairpin turn. But the reality of where did the government start to realize they were even in a turn, that they needed to turn? They were already in the middle of it. And so what happened as a consequence is they realized too late. And when you're in the middle, what you do is you overcorrect, right? You don't tap the brakes, you slam your foot down. And that's why we saw that massive step up in interest rates over these last 18, 20 months. The focus for the Bank of Canada shifted entirely away from employment and growth and entirely onto simply the one-minded goal of control of inflation. And that's the world that we've been living in up until now. The goal, let me clarify what that goal is. The goal of increased interest rates is to increase instability and uncertainty in the economy, to reduce the free cash flow in Canadian households by making your payments higher, effectively robbing you, right? Taking away from your discretionary spending, making Canadians second guess, in particular, large purchasing decisions, and make the overall consumer sentiment negative. That is the idea that tomorrow will in fact be worse than today. And if you ask yourself, how have you been feeling? How have your neighbors and co-workers been feeling? Everything on this slide explains how the Canadian has been feeling in the last 18 months. And I feel like the Bank of Canada has well and truly done their job. If this was their goal, mission accomplished. And, we've seen sales and prices drop accordingly. Now, I'm going to put a couple of slides up here, and I know there's a bunch of colorful bars here, but I'm going to simplify and just let you know that 2020 is green and 2022 is orange, okay? So 2020 is the start of COVID, 2022 is the peak of our market, orange. So here's what happened between 2020 and 2022, February, right? We had a 40% jump in housing prices. If you all remember what I said earlier about how much money was printed into the economy during COVID, it was around 30% of all the dollars in existence, right? And what you'll find is that when people realized that they didn't actually need all this money, that money found its way into investment class assets, into stocks and into real estate. So a lot of that, some people say property prices went up by 40%. Other people say the Canadian dollar was devalued by 40%. And as such, prices went up. Whichever way you look at it, there was a 40% change in valuation. Then we gave up around 20% of that 40% gain all through last year. That's what happened on the Toronto Real Estate Board. Now, very interestingly, at the start of this year, the Bank of Canada said, you know what, maybe we've done enough. Let's test the market. Let's say we're going to keep interest rates where they are, okay? And that's what they said in January. And in February, March, April, and May, for 4 consecutive months, they didn't raise interest rates. What happened? We got about a 12% regain in the first half of this year. And I know it seems like this is a long time ago, but we're talking less than 6 months ago, we saw this 12% gain. And if you're asking yourself, oh, I wonder if this interest rate thing is in fact the thing that has impacted pricing in real estate, I don't need to tell you anything more than just look at the first 6 months of this year, when all the Bank of Canada did for 4 months was just hit pause. Okay. And I will tell you as we look at future slides that I think we're going into a period where we won't see just 4 months, but we'll see a couple more months. And I think you all know what that means. This is what happened. Sales jumped 20%, 27%. It roared back. The housing market roared back. In May, they said, hang on, we made a mistake. We better start, increasing these rates again. And as they step them back up, yes, prices have come back down accordingly. Right? Now, this is a really interesting graph to look at. The red line is inflation. The blue line are interest rates. Okay. So the gap is significant, as you can see in the middle here, right? And, we were at 8%. Inflation is now under 4%. In fact, the last print was at 3.1. Remember, 2% is the target. So we are not there yet, but we are on the way. Okay, we are well and truly on the way. Guys, I'm just going to have to pause because my laptop became unplugged. 1 second.
No worries. I was just muted. It's interesting because we both try to tell a similar story, and we have a lot of very similar slides.
Oh, I think we're good now.
Okay, we're good. Can you hear me?
Yeah.
Can you guys hear me okay?
Yep.
Yep. Okay, great. So we were looking at this slide, looking at inflation versus interest rates. This is when the Bank of Canada chose to increase interest rates. Okay, the start March 2022. Okay, but where did we have this breakout in inflation? Okay, when we had it was actually back at the start of 2021, March 2021. So, in my opinion, we likely should have raised interest rates much sooner than we did. Again, another visual of the fact that we were too late to jump into action. We really need to jump into action here. We're over here. Okay. But here's the good news, guys. Earlier this year, these two lines crossed and are turned in the right direction, right? This is telling us that the impact of these interest rates on inflation is now coming into effect, right? It's actually working. And guys, the next time this kind of stuff happens, trust me when I say it's going to take 12 to 18 months for the impact to happen again. Right? So in your lifetime, you're probably going to witness another cycle like this. Don't freak out. Just wait 18 months. Okay. So now Bank of Canada had a meeting in September, no change. October, no change. November, no meeting. Therefore, no change. We now have 3 consecutive months of no change. The last time we were anywhere in this territory was at the start of this year when we had a jump in pricing. The consensus among all the major economists is that the next Bank of Canada meeting in December will likely again result in no change, month number 4. Okay. What about next year? Okay, well, let's take a look at the future. Interest rates will remain the key driver in the economy. Housing supply and demand will also play a big factor. So let's take a look at this. Oh, yeah, and the important Bank of Canada dates. Guys, if you're going to take a screenshot or photo of any slide today, take a photo of this one. Remember, I just said we had 3 no changes, okay? If we get no change in December and no change in January, which at this point in time is highly likely, okay? And by the way, February, there is no Bank of Canada meeting. This gives us 6 consecutive months of no change. By the way, what season are we going into? We're going into a spring season. Spring market is when, in traditional cycles, the Canadian market comes back to life. So if we're going into spring off the back of potentially six no change of rates, I have some quiet confidence that this spring market may look like somewhat of a normal spring market. Okay, time will tell, but if 4 months in a row gave us what we saw in the first half of this year, 6 months in a row of no change may give us something even bigger and better. That's how I'm seeing it. Okay. All right. So yeah, that's a reminder of what happened after just 4 months of no change. Now, supply and demand. Guys, take a look at this graph. This is kind of crazy. The blue line is population growth in Canada. The red line is construction completions in Canada. This goes back to 1980, and this number here is 200,000 completions of homes. Okay? As you can see, we've never really deviated much off the 200,000 mark. Maybe we hit around 250, around about here. Okay. You can always see that there's been this gap between population growth and housing supply. This crazy thing you saw here in regards to population growth was the fact that during COVID, airports closed. And so all the people that were scheduled to come to this country could not come to the country. Then, of course, in 2021, we made up the difference. Okay, so what's happened here is effectively it's just wiped out this deficit, and we're still operating up around 700,000 over here. And in fact, more, as I'll show you on the next slides. But I really want you to remember this number, guys. 200,000 units of new housing is about the best that our nation has ever done. Okay, remember that number, 200,000. And I'll show you how that relates to future slides. As we're going forward, immigration is not going to stop. Ontario needs to double its number of skilled laborers. Canada needs 300,000 new rental units by 2026 to avoid the gap quadrupling, right? That's how much of a dire strait we are in regarding supply. Now, this is the crazy number that I see here. You know, everybody's talking about affordability and, oh yeah, well, things will get affordable, or go back to 2010 numbers, maybe at some point. It's almost laughable to think that, because CMHC themselves says that Canada needs 3.45 million more homes by 2030. That's just within the next let's be generous, say 7 years, to cut housing costs as population grows. It's not going to happen. See, guys, that would mean we would need to build 500,000 homes every year in Canada for the next 7 years. We've never built more than 250,000. It's not going to happen overnight. This gap will not be closed, right? 500,000 every year. Based on that gap, it's not going to happen. So the future of real estate? Well, in 2016, Toronto Life magazine came out with this report where they looked back 50 years, and then they took that data and they projected it forward 50 years. And one of the big numbers I pulled out of that magazine was that the average house will cost $4.4 million in the year 2066, 50 years from that date. And when I read that, I almost laughed. I went, no, that's not going to happen. But I think, especially with the world that we've just seen over these last 3 years, I think a lot of us could see that number being hit well and truly before 2066, right? And here's my question to everybody listening. Who owns real estate in New York City? Because that's the way we're going, okay? The answer to the question is it's people with intergenerational wealth. And if you can't see that that's where we're going, let me tell you, that is where we're going. The future of real estate, as I see it, will be likely people with property trading property, right? There will be much fewer new entrants from the traditional get a good job, buy a house method, right? Without help from family. And it is hard now. But do you think it's going to get easier? I think all the slides I've just showed you should tell you things aren't going to get easier. Waiting's not going to help anybody. And if some of you are thinking, well, you know what? Maybe real estate's not for me, not for my kids, not for my future. There's one thing I really want to be clear on. TD published a report recently that clearly made out that homeowners are 700% wealthier than renters, okay? And that wealth is no longer about rich versus poor. It is about homeowner versus renter, okay? It studied people in the 10 years prior to retirement. The people who owned homes had net worth of 1.4 million, renters at just 200,000. It's a 7 times differential. Here's a question for all of you listening. If you won the lottery, would you share some of your winnings with your family? Okay. I don't know if we have a chat function here, but I'd love to see the responses. Some people say, not a hope in hell. I'm keeping it all, and that's fine. But for those of you who have
definitely
decent relationship,
I'll jump in. Yes, I would absolutely share 50% with my family.
Fantastic. And so here's the thing. If you have owned a property in Ontario for the last 10 years, well, guess what? You basically won the lottery. And I'd like to say it's because you're a freaking genius, but it's not that, right? It's just that you happen to be in the right place at the right time in history. And so you are the beneficiary of what happened. But on the flip side, your kids and your grandkids are, in fact, going to be the innocent victims. And they are going to need your help, right? They are going to need your help. And I want to let you know that the playing field has changed, but so has the game itself. See, the thing is, in my business every day, I talk with parents and grandparents, and they say this to me. They say, hey, Dion, we managed to make it work, so they should be able to do the same. And then I have to jump in and remind them of a couple of things. Number one, prices, while down from the peak, they're still 3 times higher than they were just 10 years ago. Wages have not increased nearly by 3 times, right? And interest rates are 2 times higher than they were 10 years ago. The stress test was introduced, which makes it effectively 25% harder to qualify. So that's another 1x. So when you add all these things together, the ability to buy today versus 10 years ago is effectively 6 times harder. Okay? And real estate used to just be about shelter for families. But in the last 20 years, it's now been realized as an investment class where people create and hold wealth. So your kids, when they want to go buy at some point in the future, will not just be competing against other first-time home buyers. They will be competing with people who hold assets and buy real estate as a place to hold their wealth. What we need to realize is we need to skate to where the puck is going to be. What worked in the last 10 or 20 years will not be working for the next 10 or 20 years for you and your family. And if you want to learn a little bit more about the impact of intergenerational wealth, there's a really interesting documentary series on Netflix. It's called Explained. And the first episode is called The Racial Wealth Gap. And when you watch this episode, it takes 16 minutes, very short. What you'll come to learn is it has very little to do with the color of your skin and everything to do with access to capital, access to credit, and access to the ability to buy real estate and transition that real estate from yourself to your children. Here's the net worth differential between white families and black families in the United States. That's 171,000 versus 17,000. That's a 10x differential. So again, if you're wondering if real estate ownership is something that you should maybe continue to pursue, there's your answer. Investing for a better future. Again, I asked you earlier, why are you here today? Likely it's debt freedom, setting up your kids, setting up your retirement. So I want to show you a very quick graph on how banks lend in different asset classes. We all know we need to invest, fine. And obviously, we here on the screen today believe property may be the better path. And let me explain to you what I came to learn at the age of 21 that some of my 60-year-old clients only learn in their 60s. And again, they wish they knew this in their 20s, right? I want you to imagine that today, I run up to your doorstep right now, I knock on your door and I drop a bag of $100,000 on your doorstep, okay? And tomorrow you wake up and you walk into your bank with that bag of $100,000 and you sit down with your bank manager and you say, sir, I want to discuss with you investing this money. First, I want to discuss investing in mutual funds, and then I want to discuss investing in property. The reason I put these 2 asset classes up on the screen, guys, is this is where most Canadians invest their money. I know there are other things, but today I'm just going to break it down to these 2. So let's say you drop that $100,000 on the desk of your bank manager, and you say, hey, go get your number 1 financial planner, bring her in the room. I'm going to give her my $100,000. Mr. Bank Manager, how much money will you lend me to invest with your number 1 financial planner in mutual funds? Okay. I've asked this question in hundreds of rooms to thousands of people, including bankers, and all of them will tell you the same answer. That bank manager will give you $0 to invest with their financial planner in mutual funds. Okay. That is the fact. Test it tomorrow if you like. So if you had your 100 grand and you go to your bank manager and you want to invest in mutual funds, well, at the end of tomorrow, well, you'll have 100 grand invested in mutual funds. That'll be it. Okay. Now we say, let's just say before you do that, you say, okay, Mr. Bank Manager, thank you for giving me option 1. Let's discuss option 2. I'd like to buy a piece of real estate for the purpose of investment. I don't know if it's in this city, the next city, or this province or the next province. I don't know if it's a house, a townhouse, a condo, but I would like to buy a piece of real estate. As long as I qualify, how much money will your bank lend me to invest in that piece of real estate? And the answer from every major bank in Canada today is 80%. They will lend you 400,000 to your 100,000, which means you now can go out and buy a $500,000 piece of real estate. Okay, so let's pause here and ask ourselves a really simple question. What does it tell you when your bank manager will lend you nothing to invest in mutual funds versus lend you $400,000 to go and invest in real estate on the same day, right? What it should tell you is that the way they perceive risk in each of these asset classes is dramatically different, right? Then you go, okay, well, which of these is safer in the eyes of that bank manager? Okay, it's the property. Okay, by a factor of how much more is it safer? The answer, 400%. Okay, property is 400% safer than the mutual funds. Mutual funds are 4 times riskier than the property market. Now, to be clear, I'm not saying this. This is how I'm interpreting the way banks lend money. And the minute I got my head around this concept, it changed my life. Because everybody thinks it's an even playing field, but the playing field is tilted to the advantage of those who choose to invest in property, right? Not only is it tilted to their advantage, it's also deemed to be the safer asset class by the people in the world who control the gold. And if you're going to make a bet on where to invest, I would bet on placing my money where the people who control the gold place their money. Okay? So now we're good and angry at the banks, right? Because they've been telling you your whole life, oh, come in, you're richer than you think, sit in the comfy green chair, we'll put your money in the mutual funds, right? That's what they've all been telling you to do. Meanwhile, they wouldn't put their own money there. They put 0 of their own money there. Okay? But now let's turn this into something meaningful, impactful on you and your life. Let's say your goal was to make $100,000 over a 5-year period. Okay? That's an admirable goal. Well, to do that with that mutual fund, to make $100,000 with your 100,000 invested, you need a 100% return on your money, which is about a 20% a year return on your mutual funds. If anybody has ever got that for 5 years consecutive, please call me. I would like to know where you invested, and I will also invest. Okay? Again, I've asked this question in hundreds of rooms, and nobody's ever said that they've achieved that. Alternatively, if you want to make $100,000 on this $500,000, okay, what you need over 5 years is a 20% return on your $100,000 invested. Put another way, it means that the property that you bought for $500,000 increased by just 4% a year. That means you bought it for $500,000. At the end of the year, it's worth $520,000. Has anybody ever experienced that in their lifetime? Of course, everybody who's ever owned a piece of real estate in Ontario in the last 10 years has experienced that. Have you experienced it for more than 1 year consecutively? Yes, multiple years, 15 years, in fact, is what most of us experienced up until what happened these last couple of years. So let me be clear here. What the marketing machine of the financial institutions is telling you is put all your money in mutual funds, okay? And chase 20% returns, which you've never got and never will. Whereas over here, if you were just to chase 4% annualized returns, which all of you have probably achieved and your parents have and your grandparents have, like in their lifetimes, real stuff, then you can achieve the same dollar return in the safer investment class. Okay, I hope that crystallizes some ideas for people.
I'd just like to ask, I know your background is as an investment planner, so I'm sure you were selling mutual funds. Do you still personally invest in mutual funds?
I do not. I don't have $1 in mutual funds today. Yeah. And now, let's look at this compound effect for a second. So I'm going to run with this $500,000 example, and I want to be clear. I understand that maybe you're not buying a property for $500,000. It could be $250,000. It could be $2.5 million. I'm using $500,000 because the math is simple. Okay, for me and you. So at $500,000, if property grew at just 5% a year, which by the way is below the GTA 50-year average, okay? So I'm using a conservative average number. Then what happens to that property that was at the start of the year worth 500? It ends the year at a value of 525. And what we get is we get to start year number 2 at a value of 525. And if we get the same 5% growth, then the dollar increase is not just 25 grand. It's, in this case, 26 and a half, and so on and so on. And so at the end of 5 years, what happens is the 500 grand asset is now worth $638,000. Now, if that was the case, then here's what's happened. You've made 138 grand in growth. Also, during that time, you've collected rent and you've paid down your mortgage. And this would be your net worth position after 5 years on the acquisition of just one investment property. And I want to point out a couple of things here. This 5% a year, every year, beautiful, straight line, 5 years in a row, is that realistic? The answer is no. The way the world works is we have 10%, then we have 0, then we have 4%, then we have -4, right? But 5% is the average, okay? The other thing that I want to point out here is that I've assumed neutral cash flow, okay? But I also want to talk for 1 minute about the reality that is, in the market that we are in, neutral cash flow may not be possible, and many of our clients are now in a position of negative cash flow. So I want you to imagine that you bought this property, and after all the expenses are calculated, the rent is short $500, and therefore you've got to reach into your pocket every month $500 to sustain this property. So let's just play out this example. That means that at the end of 5 years, you've outlaid $30,000 cash out of your pocket to sustain this asset. Okay, $30,000. That means that this number here, which is at 189,000, would be only 159,000 in net worth increase. First question, would you still be okay? I think the answer is yes. Second question, if you didn't invest in this piece of real estate, what would you have otherwise been doing with your $500 a month investable funds? The answer for most people, mutual funds. They would be investing in mutual funds. And I've run the numbers, and you can do them on an investment calculator yourself. If for the next 5 years, every month you decided to invest $500 every month for 5 years, you've invested 30 grand. Let's say you got the same growth, 5% growth. Your 30 grand would now be worth $35,000. Most Canadians are pursuing that path, turning 30 grand into 35. Over here, you could be turning 30 grand into 159,000. Negative cash flow? Yes. But are you doing the best you can with what you have? If you're investing in mutual funds, I dare say probably not. Okay, now let's just say that we got this 189 return over 5 years. If we held the same asset for 10, 20, 30 years, this is what the numbers look like. I want to remind you, your investment was 100 grand, which was just a 20% down on the 500K asset. And let's take a look at the ROI. This is where the numbers get absolutely insane. This is 189% return on your money. What this means is you invested 100 grand, and 5 years later, you still have your 100 grand equity there. And on top of that, you have another 189,000. So you have 189% return on your money. Now that top number is cool to look at, but what you really should be focusing on is the bottom number. That's the real world dollars, the impact on you and your family. What that means is every year you own that asset, your 100 grand helped you make 38 grand every year for 5 years. I don't think your financial plan is talking to you about a plan like that, right? And the longer you hold it, the greater the compound. And so if it's 10 years, you've made 42 grand a year every year for 10 years, 55 grand every year for 20, $72,000 a year every year for 30 years. Okay? Guys, every time I go to invest my money, I always ask myself, can I find a better return? Okay, I have 2 young daughters, and I'm fine now. So my money I'm investing is their money. I'm the custodian of their future. And every time I go to invest, I cannot find something better than this that I'm comfortable with from a risk mitigation perspective. Okay. Ask yourself the question, are you comfortable with the returns you're getting? Are you comfortable with the risk you're taking to get those returns? And when it comes to real estate, guys, this is not flash in the pan. All of my plans are built on 10 and 20-year timeframes. And what Warren says here about stock, just change the word stock for real estate. If you are not willing to own real estate for 10 years, do not even think about owning it for 10 minutes. Okay. That's my approach. That should be your approach. And I'm going to end with this plan that we roll out for our clients. I call it the 15-year, $2 million plan. It's very simple. If we get a 5% annual return, which is that average that we talked about earlier, but actually it's below the average, there's an investment rule. If you don't know it, please Google it. It's called the Rule of 72. And it basically says at a certain rate of growth, whatever number that is, this is how long it would take for your asset to double in value. At 5% growth, that number is 14.4 years. So I rounded up to 15. Okay? So at 5%, real estate will double in 15 years. So I want you to imagine today, you go out and buy that piece of real estate for $500,000 and you finance the entire amount. Okay? Because you can borrow the down payment from other assets. And if you did that, well, you're at sort of a net neutral. And you'd look at me and you go, well, what did we just do, Dion? We just went into debt. Okay, I get it. But let's fast forward 15 years. In 15 years, if all goes well, all goes according to history, then that asset's worth $1 million. The debt's been paid down through regular rent collection, mortgage pay down. And so what we have here is we have a $700,000 positive impact on your personal net worth. Okay, that's the ownership of just one piece of real estate. And, I know we're not at 2 million. And most of our clients, when they approach us and we put them in this plan, we explain to them that your goal is 3. Because if you get to 3, then we take the 700K, we multiply it by 3, and we hit the 2.1 million. This is the simple plan that we've been laying out for our clients over the last 2 decades. And I'm happy to say our numbers were grossly understated. Our clients have significantly more, 30 to 50% more than the number you see on the screen here. These are people in their 40s and 50s going into retirement with millions and millions of dollars. So hopefully this has got you thinking. And at this point, I'm going to wrap up, say thank you, and I'm going to hand back to Ryan.
Dion, thank you so much. That resonated a lot with me. In fact, I'm probably going to go through my presentation a lot faster because, we know the fundamentals. We know the principles. We know what it takes to invest and be successful in real estate. I think what I'm going to do a little bit differently with my presentation here as I upload it, or I connect. Can you guys see my presentation?
Not yet. Oh, it's coming.
Yep.
See it now? If I switch slides, can you see why Preconstruction?
Yep.
Okay, cool. So, first of all, a few things. It resonates with me for many reasons because I'm going to show you real life examples how I've applied the principles you just talked to build the real estate portfolio that I have today. And when I started investing in real estate 23 years ago almost, I must have read about the Rule of 72 and probably in Rich Dad, Poor Dad, because my assumption investing in the Toronto real estate boom was Toronto's the market because I can almost, it's very, REITs are investing here. You can almost guarantee you're going to get a 5% annualized return, compound return in Toronto. That's why I invested in Toronto. And obviously it's been a lot more fruitful than that over a short period and a long period of time. So for those of you who don't know me, I'm going to talk again about a lot of the same principles as Dion. I'm going to give you hopefully real life examples that resonate and really show why real estate for me has been a means to create freedom for myself, my family. Before we met yesterday, Dion, to go through the presentations, and we were looking at my portfolio, and you asked me, you're like, so why do you do this? And it's for me, it's passion. I don't know for those of you out there who are familiar with the term BHAG, it stands for Big, Hairy, Audacious Goal. It's a Jim Collins business coin term. And my BHAG is to create $10 billion of wealth for Canadians through real estate. And, when I think about why that's important to me, it's interesting how you just talked about 3 properties should be the goal, 15-year goal. For me, real estate has been a way of freedom because, just to share a quick story, I lost my father at the age of 3. And by the age of 4 or 5, earliest years I can remember, I was in the back seat of my mom's car and she was driving around picking up rent checks and cash from strangers. And I remember at a young age thinking, what is this all about? And I think that's probably why I got interested in real estate at a really young age. But the importance of that story is that as a single parent, she never remarried. She was able to provide an incredible life for myself and my sister. And in fact, the first condo I ever owned was a condo that my mom bought by selling one of her investment properties. She bought my sister and I a condo in downtown Toronto. We moved in together. And when we look at my portfolio, which I'll show everyone, that is an extension of that first property that my mom had bought for me. And without that initial, help from my mother, I would have never been able to achieve this. So it's cool how this all kind of ties together. So the investor operating system is an easy step-by-step system for creating serious wealth through real estate, mainly pre-construction condos. So Dion talked about all these principles. I want to tie together how I've used pre-construction as the real estate asset class with these principles to scale the portfolio I have today. That's the power of leverage, the miracle of compound interest, passive income, and the time value of money. So real estate is a simple system when you look at these 4 pillars. So the power of leverage. Leverage is the reason some people become rich and others do not become rich. It's Richard Kiyosaki again. I must have read a few of his books. So what does that mean? Other people's money. OPM is often heard in the real estate investing community. That's the bank's money. It's when you get a mortgage from the bank and then your tenant pays it off. But when you look at pre-construction, it's a little bit different. Pre-construction is actually the ultimate leverage because you're investing without a mortgage. So let's unpack that. When you buy a property, you buy your new home, you go to the bank, you have to go through this whole process to get approved, and then you get a mortgage, and then you pay a mortgage payment. With pre-construction, you can invest without a mortgage. So you're able to get all of the leverage without paying the bank money or paying the developer money. So it's a huge amount of interest. And when you factor in compounding on top of that, it becomes much more significant. So this is another quote. I obviously like to share quotes. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Albert Einstein, I'm not sure if he was a real estate investor or not, but he was a really smart guy. And when I show you my portfolio, I will show you exactly what he means by the miracle of compound interest or wonder of the world. So compounding plus free leverage equals huge returns. If we look at the unit I bought in Corktown, so it's an 801,000 2-bedroom. To use the example that I like to use, because I look at the long-term average the way Dion does, and I use 5% as a conservative outlook in my investment, 5 years appreciation becomes $221,000. So just to put that in perspective, I've just bought a condo. Actually, I haven't bought a condo. I put down a deposit on a hugely leveraged, highly appreciating asset where I don't have to do anything for 5 years. But in 5 years, when I actually take out a mortgage and buy it, it is appreciated, in theory, $221,000. So you're getting the appreciation of, the capital appreciation, but also the rental appreciation. Passive income. So what is passive income? Passive income is the ability to be able to invest and have passive income. So it's earning money while you sleep. So it's not getting another job. It's having income earned while you're not actually working. Now, pre-construction is an easy, hands-free way to give you multiple streams of passive income. So the time value of money. Real estate, I think you've highlighted this incredibly well, is the safest and most lucrative investment over a long period of time. So I just want to point out, there was someone who commented based on TD and their outlook for the next year. But, the media really focuses on a very short-term window, typically what's happening today. The news is what's happening today in the news. And it also feeds off media. I don't want to get into, economics and big banks and government and stuff like that and trying to paint a picture. But anyway, like what we're talking about here is long-term growth. Okay. So that's why I'm able to invest today in a luxury building at $1,050 per square foot with a 10% deposit and no closing costs. Because if it weren't the market that it is today, there wouldn't be opportunities like this. And what I find really interesting is I can almost guarantee that the majority of people are going to wait until the market has gone up, and prices are going to be 20, 50, probably 60. Probably most people will jump in when prices are up $100,000. So right now, for all of the reason Dion has highlighted, I'm about to show you what I've accomplished over the last 20 years, is you should be taking advantage of opportunities in the market today, because there are opportunities that you will not see when things turn around. So I'm going to fly through a lot of this because Dion, you talked a lot about it, but pre-con condos, it's the easiest way to scale a portfolio. So, this is the same article I think you shared, and I just want to highlight something. So when I first started doing this many years ago, almost 20 years ago, most of my clients were high net worth buyers. So they were doctors, they were business owners, people that had achieved a lot of success. And then it was interesting. They ended up being, real estate investors who had created a lot of wealth through multi-residential or other types of real estate. They were burnt out because it became a job. They were burnt out because they had to do cash infusions, and they liked what I had to say. So a lot of my best clients who own 10, 20, some of them, almost 30 units, are real estate investors who pivoted from owning multi-residential and moved into pre-construction and condos, and I manage their investments. And the reason why I say that is because, real estate is about creating freedom. And it's interesting. I go to a lot of real estate meetups, and I've been doing this for so long. I've been going to all these things. And the goal seems to always be that people want to get to a point where they can quit their job so they can become a full-time real estate investor. And to me, I've always just scratched my head. Doesn't that defeat the whole purpose of why you're investing in real estate? You don't want a job. You want this to be as passive as possible. So what I'm telling you here, and you're about to see when I show you my portfolio, is keep your job. Investing in real estate, always over the long term, isn't about a job. So, I don't think I finished that first point. So the real estate investors, the doctors, the high net worth people used to be the people who invested with us the most. And to all of the points into this article, is that mom and pop investors are now, over the last 24 plus months, have been the most sought after investors in our database. So a lot of parents are recognizing that their children probably won't have an opportunity to own real estate. They're recognizing that probably their parents are wealthy because of real estate. And that is now the people that are buying most of the real estate with us. So I just want to give you guys a real life example. Cash flow through capital. I'll talk a lot about this when I show you my portfolio, but essentially this is buy and hold. So, there's a lot of things in the news about people trying to buy and speculate and flip. This is a long-term gain. Everything I'm talking about over the long term. I've had a lot of clients make a lot of money assigning units, and that's a different story, but that's not what we're talking about today. So this is a real life example, cash flow through capital. So this unit I purchased in 2017, paid $602,000. It's a lovely south-facing 2-bedroom and den. I had it appraised earlier in the year at 1.175. Current rent's $3,900. And the current mortgage at the time of refinance was $482,000. So what happened was I got it refinanced. I had to pay off $482,000. And then after paying off the mortgage and getting 80% loan to value, I was left with $457,000 in my pocket. Okay. So that $457,000 was tax-free and it was tax deductible. I'll pay taxes on it one day when I sell the property, if I sell the property. But the important thing is I just pulled out $457,000 tax-free. to do anything I want with it. If I'd sold the property, I would have paid capital gains. Now I am paying interest, but that interest becomes a tax deduction. I call that double dipping. That's a huge tax incentive, but you don't see that available with a lot of other investing. Now, when I look at my portfolio, which as of today is valued at $36 million, the most important thing about achieving this is it's all about time in the market. It's not about timing the market. Okay. So when you're doing this, you're not waiting for the market to come to you. You're jumping into the market and you're waiting over the long term for the market to be able to offer you these types of returns and this type of security and freedom. So I hope all you guys can see that. Sean and Dion, are you guys having a hard time? Can you see the 36 million?
At the bottom, yeah.
Yeah.
Okay, cool. So that's the most important part. So as of today, current value. So just to show you guys the IOS, the pillars of real estate investing in action, just at 4%. So this is a very conservative number. In 20 years, if I did nothing today, my real estate portfolio, I'm not talking about cash flow. I'm talking strictly about the net worth of my portfolio is going to be worth $80 million. In 30 years, $117 million. So this really highlights the impact of compounding at a large sum of money. In 40 years, 60 years, well, I'll still hopefully be alive. I'm all about the longevity movement. 4% in my lifetime, I'll have a portfolio worth $382 million. And the reason why I'm going to continue going all the way here is because we're really, really talking about multi-generational wealth. And Dion touched on this really elegantly about this being passed on through generations, through the parents, through the grandparents. And when, I always find fascinating when you go to countries around the world, major markets, you see that real estate is a lot more expensive in most markets than in Canada in major pockets. And they're much older markets. But as Dion said, real estate is being transferred amongst the wealthy. And everyone else are tenants. And people are very afraid of that in Canada. But that's the reality of where the market's going. And the people that own real estate are going to be the people that are going to be the wealthiest. So, now let's take a look at the 6.7% compounded growth. And the reason why I'm using 6.7, I'll show you in a minute, is because the compounded annual growth over the last 45 years is actually 6.69% for the GTA market. Now, this is just not to brag or do anything like that. This is to simply highlight the power of compounding. And if you just take a 4% conservative approach and you change that to the historic 6.7 approach, in 20 years, my real estate portfolio is valued at $133 million. And in 30 years, it's $254 million. And, it becomes a little bit ridiculous at this point. But if I sat here and didn't show you guys a number and I said, based on my portfolio, and I plan on passing this on to my family and my grandchildren, and it'd be worth potentially $87 billion one day, you guys would probably say I was nuts. But what's really interesting, and you have this slide, Dion, but I kind of broke it down a little bit differently, is I find it so interesting that when, I know so many people's parents and grandparents who talk about, I bought this house for $64,000 and today it's worth 1.2. Everyone knows a story like that. So we're not making this stuff up. This isn't a speculative, sure, there's speculation, but we're looking at this based on historical assumptions, a large data set of historical data, and we're making a forecasted approach. So I don't want to go over this slide again, but what I've kind of done just differently, I don't want to spend too much time, is, if you take it over 10 years increments, real estate has performed incredibly well. And this includes the 80s, 90s, 2008 financial crisis, 2017 policy introductions, the roaring 20s, which Dion talked about, in early 2021. And when I talk about those different times, those are interest rate environments, cyclical interest rate environments where interest rates have gone up, prices have gone down, interest rates have gone up, prices have gone up, right? So, the policy was a little bit different. The roaring 20s was a supply demand issue. The early 20s is the example that you actually showed, Dion, where everyone's like, what's happening? And all of a sudden rates remain flat for a few announcements, and prices roared up.
Hmm.
So again, like I just want to highlight, this is tying this all together. This is a very long-term approach. And another reason why I think this is important to talk about this, like I'm in the process right now, I'm working with accountant and a lawyer, and I'm setting up a trust. So this for me was the goal, was to buy 10 properties and retire at the age of 50. And there's something, a miracle, as Albert Einstein said, that happened in my 12, 13, 14 years investing in real estate, where I have a massive amount of equity that comes through my portfolio through compounding and through leverage. And I don't have to sell real estate. I use capital as a way to do cash flow. And just to give you guys an example, I don't know if you can see it, but I just refinanced these 3 properties here, 3 in one building. Thursday morning at 9:45 a.m., I'm going to TD and I'm pulling out $1.2 million. And I'm not paying any tax on that money. So I'm living off of my portfolio. Yes, my interest rate's going to go up. I'll deduct that interest. But that's a really important piece, because I've then gone and bought my dream home, which is right here in Lawrence Park. And I've used the equity to scale up, scale up, scale up. I bought my dream cottage in 2020 because of all of the equity that I've accumulated through compounding. So this is, key takeaways, like everything Dion said, we're very aligned with. This is it in action. For me, just the key takeaways, the investor operating system, it's a tried tested system. I think it's for mom and pop investors. It's very simple. It's hands off. It's very important you guys work with someone who walks the walk and can truly guide you. The multiplier effect, it's literally how I took one property and turned it into over 40. Pre-construction is the ultimate leverage. It allows you to invest without a mortgage. It's as easy as owning a mutual fund. And the easiest way to scale a real estate portfolio. Time equals money and reduces risk. I truly believe history believes real estate is the safest and easiest way to grow serious wealth, multi-generational wealth. Over long periods of time, and it's passive. There's no reason for me to be able to have the amount of real estate I have. I wouldn't be able to do it if it wasn't as passive as it was, this asset class. And one quick thing I want to touch on is, because I get a lot of feedback, there may even be comments right now, well, maybe you're wealthy, Ryan, you're able to get as much financing as you want. No, it's not true. When I go into the bank, other than TD, because they know of my one company, they go and ask, how much property does Ryan Coyle own? And only one property shows up. And when they pull my credit report, only one property shows up. So there's a way to structure this all above board in a way that you could do this through holding companies to hold your real estate. There's tax advantages. I'm not a qualified accountant. I'm not going to talk about that, but my team will help you guys achieve exactly what I've achieved. It's not going to happen tomorrow. This isn't crypto. Things aren't going to go nuts, but this is what we're talking about when we want to deal with mom and pop investors, because we're helping create real multi-generational wealth. Sean, that was a mouthful. So look, talking about multi-generational wealth, I've just invested in Corktown condos. You've helped a lot of people create wealth through pre-construction as an asset class. So you know it incredibly well. And if you can take it away, do you want me to share the slides, or do you?
Yeah, I can do it. Yeah, thank you. I can just present. So I think it's easier. It's just one. Give me one sec. Okay, do you see my screen?
We do now. Yeah.
Okay, perfect. Awesome. Okay, so first of all, I just want to thank you, Ryan, for creating this opportunity. And Dion, that was pretty informative. I learned a lot. I'll just take this as an opportunity to just use this as a segue. Basically, it's interesting. And my background was in finance, graduating from university. And I basically only lasted 1 year in finance. And I was actually dealing with mutual fund. And it's ironic. And then I switched to real estate right after. And I've been doing this for close to 17 years. Just to give you a little bit.
2005?
2006, 7. Yeah, that was the time. So basically, So basically, I understand the rule of 72. I understand the magic of compounding. So I think we all have that in common. So and I couldn't find any better platform than real estate to basically give you that opportunity to create wealth. And one thing, just like Dion, I have two kids. I already have a portfolio. I'm just doing this for my kids as well. And we've been educating a lot of people over the years to do the same. So I've been involved myself with 32 projects. I represent developers actually in this case. We have a lot of vendor partners and developers. Slate Asset Management is only one of them. But the reason I wanted to use this as a segue, talking about personal created wealth. I have a chance, and I'm privileged actually to represent a lot of institutional guys, and we represent their projects and their condominiums. Slate Asset Management, basically one of our top clients. So they have a portfolio of basically over $14 billion across the globe. So this company has two REITs, one grocery REIT and one office REIT in the US. And they're basically they're publicly traded, and they also have a huge mixed-use pipeline coming in the next few years. So we're involved with few of them, and which I'm going to point out later in this presentation. But overall, this is not your average Joe developer that we're dealing with. So they manage a lot of institutional money, a lot of private equity firms, and they also have great partners, which I'm going to also touch base on that as well. So this is the portfolio as we basically stands. So right now they have $2 billion in gross residential development value, and they also have huge portfolio in industrial and commercial side, especially in Hamilton area as well. In terms of residential portfolio and also commercial, so right now we have Junction House in occupancy. This is in Junction area, going through closing, I would say probably sometimes in spring, summer of 24. One Delisle was one of our greatest, basically iconic projects that we brought to market in 2021, selected by Stories Publications in 2021 as Project of the Year. So it was a great success. It was the very first project ever done by Genie Gang in Canada. So Dixie Alden Mall is now owned by Slate Asset Management as well. We're also working with, on 100 Lombard at around Yonge and Richmond area, 2 towers at 685 Lakeshore, one St. Clair Avenue West at the corner of Yonge and St. Clair. And last but not least, Steelport, formerly known as Stelco, 800-acre, the largest industrial commercial initiative in North America in Hamilton. This is very interesting, this story of Slate, founded by two brothers. Their mom actually was from Hamilton. They started a company. 20 years later, they've done over $14 billion in transactions. One of them basically philosophies that they bring to table in any sub-market they basically enter, they go big and they try to revamp the entire market that basically they're in, because the number one beneficiary in that market is themselves, right? So that started with Yonge and St. Clair. If you look at all those white buildings, so they're all owned and they accumulated all these over the years, I think 11, 12 years. And so they own 10 buildings. And this is the very first time working on 32 projects in this city and multiple developers' accounts. This is the very first time I've seen it myself that one major institution, one developer owns all 4 corners of the entire intersection in City of Toronto. And that's the case with the Slate. So this speaks volume, and that tells you basically their vision to not only bring product along basically Yonge and St. Clair corridor, but also revamp the entire experience, the retail, the specialty store, the public realm and everything. And they're bringing the very same approach to Hamilton as well, which we're going to talk about that as well.
I don't think I've ever worked with a developer or know of one where they own an entire intersection at one of the major intersections in a country.
Absolutely. Like if you look at it, Yonge and Eglinton, I would say Yonge and like Dundas Square, Yonge and Bloor. There are very few major intersections in our city, and Slate happened to be the owner of the entire basically intersection in Yonge and St. Clair area. So they want to do something different. They don't want to just do cookie cutter product actually in that area. They want to do something as big as what we did at One Delisle. This was our signature project at that area, and it happens to be at the pinnacle of Yonge and St. Clair. That was one of the reasons Jeannie Gang, one of the most known, we call them star architects in the world, agreed to work on this project. And this is probably the first, if not last, project she's done ever in Canada. She's one of the top 100 most influential people in not only in industry, but also in the world. And we had great success back in 2021. We sold 70% of the project in less than 8 weeks. Just for your audience to understand the magnitude of this project and the value of this project. So our average product is dollar. I'm talking about dollar per square foot for this project is $2,600. So
Wow.
that speaks volume, and in terms of like the types of craftsmanship and the details, and basically the level of quality they're going to bring to this project.
It's incredible.
So the reason I want to touch base on One Delisle is because almost same team who worked on One Delisle work in Hamilton's project that we have, Corktown. So you can expect kind of like close to same level of craftsmanship and basically quality and features and finishes as well. This is an example of one of our units in One Delisle. You can see it is beautiful, and you can expect same level of details in Hamilton as well. Okay, so what about Hamilton? So there are a lot of buzz about Hamilton in the past few years, and rightfully so. That market is going to be completely different in the next 10 to 20 years. That's a very same reason Slate Asset Management decided to tap into this market. They basically went through the acquisition of Stelco at the time. That was the name known to basically to the market. Now it's called Steelport, 800-acre basically along water. And that's for those of you driving from Toronto towards Hamilton. When you look to your right, so that's pretty much everything on the waterfront is as part of this initiative. And Slate's goal is to completely redevelop this very area in the next 10 to 20 years. It's believed that they're going to bring 23,000 jobs into Hamilton's market and also inject close to $4 billion into Ontario's economy as well. This is a new branding that we have. We had our PR event a couple of weeks ago in Hamilton. So basically, if you look at, I don't know if you look at my cursor, so all these buildings going to be occupied by AAA companies. I know there's some discussion about some major tech companies also coming and occupying some space here as well. This is for the very first time public going to have access to this area, because before that basically didn't exist. So they're going to also revamp the public realm on waterfront as well here. The reason we wanted to touch base on Steelport is the scale of Slate Asset Management's basically investment in Hamilton. They're there to stay for basically the next few decades. And for that reason, they're also bringing their residential portfolio into downtown Hamilton as well. The very first project we're bringing to this market is called Corktown. So the name, we got the name from the actual plaza that now exists. If you Google the name, Corktown Plaza, that's actually the site located just 2 blocks south of a main GO Transit hub in Hamilton. 27-story, 372 units. We have a very wide range of different unit types, starting from studio all the way to larger 2 bedrooms. So this is the team behind the project. Obviously, Slate Asset Management is our vendor partner here. My company, Rad Marketing, we're doing everything and anything to do with sales and marketing for this project. Janet Rosenberg for basically landscape design, vendor brand, and the list goes on and on and on. But the very important partner for this project, this is something, Dion, you can correct me if I'm wrong, being from financial sector actually. I've never seen this myself. For the very first time in my time in the business, we have Bank of Montreal as the partner, equity partner on this project.
Yeah,
So
that is rare.
Yeah, so this is something I've never seen myself, and going back to Ryan's point, I've been involved with over $6 billion worth of real estate in pre-construction, and this is the very first time I see any of major banks putting equity in residential building. And the reason for that, I wanted to maybe take you guys back. There's a big shift happening in residential arm of the business. Traditionally speaking, we have a lot of rich institutional money putting money into basically res office buildings, different types of asset classes, right? But in the past few years, especially in the last, I would say 5-6 years, we see a big shift from those institutions, and they're developing their residential arm, and they're investing in future condominiums. And this is a prime example for that. And Slate is one of 4, institutions that I'm basically working with, that they're going to bring huge portfolio of residential, mixed-use buildings into the market in Greater Toronto, Hamilton area in the next few years. And that speaks volume. Going back to Dion's point, I myself also not only follow like successful individuals when it comes to investing, but also I call these institutions people that they deal with smart money. These are the guys investing in your basically pension funds. They need to provide, they need to create interest, and they need to provide growth to shareholders. And them taking this vehicle of pre-construction and residential condominium for that reason, and I think that speaks volume. But let's look at some fact about Hamilton. One of the things comes to mind, which is very important. They're basically institutions like educational institutions, McMaster University and Mohawk. McMaster, basically by far one of the top schools in Canada, especially when it comes to medical school and healthcare programs. Between two institutions, this is very interesting. And that's one of the reasons we have a very robust rental market in Hamilton. Between both institutions, they have close to 50,000 students. But the problem is they only provide 4,000 residences. So meaning that lots of those people, like 46,000 of those people, unless they live in Hamilton, they either have to commute from other cities or they have to rent somewhere. And that puts a lot of pressure on rental market in Hamilton. Another great thing about Hamilton is basically proximity to not only U.S. border, which is a great thing, but also with GO Transit Hub to Toronto in less 40 to 50 minutes. There are some changes happening also within Hamilton. There's new LRT coming, serving the entire city with 17 stations, which only going to make it much better. For those of you familiar with Waterloo, that happened a few years ago, and basically it took the market, we're talking day and night from what they had before LRT and growth projected and what it is today. So that I think we're expecting same thing in Hamilton as well. So this is the map showing you the future LRT station. If you look at Corktown, we're only a few minutes from James Station, only a couple minutes walk. This is pretty actually great for transit. And we're only 2 blocks walking distance, 4 minutes walk. Actually, I walked that myself to main GO Transit Hub, basically in Hamilton. There are a few reasons that we think Hamilton's market is going to be great opportunity for most investors moving forward. Obviously, the market, both on the rental and resale side, have shown tremendous amount of growth in the past few years for many reasons. Transit expansion is something that is coming to Hamilton. It's well funded by government. $3.4 billion going to be injected for that reason into LRT expansion. We have also a huge waterfront redevelopments happening to Hamilton's market with many amazing residential condominiums. Employment growth, aside from Steelport, that is projected to bring 23,000 jobs in Hamilton. There are a lot of actually improvement in city of Hamilton. There are a lot of tech companies expanding here. There are a lot of basically movie studios actually expanding here. They already exist, but also expanding their basically brick and mortar facilities as well. But also education. McMaster is one of the most established universities in Canada, number 4 as a matter of fact, perhaps one of the best medical schools in Canada, and that alone going to bring a lot of future basically students to the city. We looked at the numbers last year to this year. The number of international students grew by 17% in Hamilton. So overall, we project to see $7 billion from all different levels of government and private sector to be coming to Hamilton's market in the next few years. Going back to rental, basically scarcity that we have in Hamilton, this graph basically, we kind of like made it a little bit nicer with some colors, but it's basically, we looked at Bullpen, basically research company that pretty much every major developer in the city of Toronto and basically Greater Toronto Hamilton area used before they bring their product to the market. So we looked at one of the last reports they did on rental market, and surprisingly, so if you look at the rankings, obviously starts from Toronto as number one market, and it goes all the way down to other sub-markets. But if you look at Hamilton, standing on par with city of Richmond Hill in terms of dollar per square foot of $3.44. That speaks volume. I know there's a lot of buzz about Mississauga, Oakville, Brampton, like Pickering lately, but city of Hamilton's getting the most amount of dollar per foot when it comes to rental. And again, that's one of the reasons the rental market here is pretty strong. Going back to the building and all the amenities, one thing we noticed researching for this project before we basically brought this to market was that there was a great void in the marketplace in Hamilton, whereas most developers, they focus on basically cookie cutters, very small unit type of product. And rightfully so, that was the market back in the day, and but that's changing. There's a growing basically population expected for Hamilton, and I was looking at the very staggering number. After Toronto and Ottawa, Hamilton's becoming third destination for newcomers, and with that, they see a lot of families that have a lot of young professionals going to come to Hamilton, and they need something a little bit more on the premium side. Not everyone wants to be in cookie cutter buildings, and that's basically why we created Corktown to fill that void in the marketplace. Starting from the lobby of the building, you can right off the bat see that experience. It's very grand. It's going to be a lot of great features associated with this. Slate Asset Management is very big in art scenes as well. We incorporated a lot of NFTs into our projects in the past as well. So a lobby of this building is not going to be exception either. We're looking at 27th floor terrace lounge and 5-pit area. Again, this is looking over Hamilton's Scarborough area as well. We also have an amazing zero-edge pool on 9th floor, something I've never seen like this pool in Hamilton in any other projects myself. We have yoga studio on 27th floor. There's no shortage of amenities in this building, to be honest. One of the greatest things that we have here, not every building in Hamilton, they have 24/7 concierge, but that's not the case here. We also have 24/7 concierge as well. The overall mix for this building, and I think to me, in my opinion, I'm buying a 2-bedroom. I know Ryan is buying a 2-bedroom. The best value in this building is 2 bedrooms, especially the corner ones, because you have amazing view of not only water to the north, but also you have great view on the southwest units for looking over Scarborough as well. Everything about this building is basically hand selected by our interior designer firm that we're so proud to work with them. So we also work with them in another project. Looking at some of the den options, you can use them either as office space, or you can also upgrade and have Murphy beds, built-in Murphy beds to be added to dens as well. This is something really interesting, especially knowing that there's a big demand on the student side of the market. So I think that's something that people would appreciate for sure. One thing that we're very proud of, looking at our kitchens, everything from fridge, freezer, and dishwasher, all integrated into the cabinets, and they're all panelized with cabinet doors, something that you don't simply see in Hamilton. As I said, this is more on the premium side, and this is something that Hamilton's market has been missing. We have two color palettes that we can choose from. This one is on the lighter side. It's more Japanese style. I was talking to Ryan. It's very interesting. We have very same look in One Delisle, the project that we represent at Yonge and St. Clair. But the difference is we're paying close to $2,700 per foot at One Delisle versus here we're talking about $1,050, $1,100 for some units. One thing is very standard in this project: everything black matte finish. You see it throughout the building. You don't have to pay for upgrades. All standard throughout the building. Another great thing to echo what Dion and Ryan said, leveraging time. The closing of this project is in 2028. Our first tentative day basically is 2028, which will give you enough time to build equity over time between now and then. And on this, I'm going to pass this to Ryan. I think this is your slide. I'm going to just jump out and I'll pass it to you.
Okay, great. Thank you, Sean. Can you guys see my screen? I'm flying through slides right now.
Yep.
Okay. I'm at the Hamilton condo boom.
Yep.
Good. So guys, this has been a really long presentation. I hope everyone's found a lot of value. I'm going to get through this quickly. This is really the nuts and bolts. Like, obviously, I hope you guys feel like you learned a lot tonight. This is why I'm investing. So I had an incredible amount of success investing in Toronto 20 years ago. And it was really the Toronto condo boom. And when you look at the fundamentals of what made Toronto the market that I invested in 20 years ago, you see the exact same fundamentals in Hamilton. So what's different from Hamilton, Mississauga, Richmond Hill? Well, first of all, it's a metropolis. And what do I mean by metropolis? It's on the waterfront. So most world-class cities are on the waterfront. It has a downtown core with skyscrapers. It has a major university, McMaster University, McMaster Hospital, research hospitals. So it's a different economy. And, ever since the GO Transit connected Toronto or Hamilton directly to Toronto, it has been on my radar. And I now own, I think I have 11 or 12 doors in Hamilton. That has just happened over the last 3 years. So I'm incredibly bullish on Hamilton for all of the reasons Sean mentioned and all of the reasons why I invested in Toronto 20 years ago and had an incredible amount of success. So why am I investing here? I'm personally investing here. I don't think I talk about luxury in these incentives here, but this is a standalone building. One Delisle in Toronto is, developed by Slate. It's going to be an absolutely stunning building. And this will be the Hamilton flagship building for Slate in Hamilton. So incredible building. I'm paying $1,050 a square foot for my particular unit. For a luxury building is very, very good value. But I've negotiated incredible incentives here for our clients. So I've promised the developer that I will go and sell 30 units. And in order to do that, then I'm going to get these special incentives for myself and my clients. We've already sold through quite a few of them. And why this is a special deal is because you're getting a 1-year rental guarantee. The financial pro forma that I'm about to show you is based on this rental guarantee, which is a very good financial pro forma. I do believe rents will be higher by the time the building is completed, but that is a worst case scenario. So you know what your rent is going to look like. We're offering Property Management Connect.ca. That's coming from us. No closing costs. I mean, that's just not the reality of buying pre-construction. So by no closing costs in the asterisks, I mean that you're not going to pay any development, educational, or different levies. You'll pay your legal fees and your land transfer tax, similar to resale. If you're an assignment buyer or flipper, there's not going to be any fee to do that. We've got discounted parking. One of the unique incentives about this project is it has a direct shuttle to McMaster. One thing, just to take a step back, why I like this building is because it's a few minutes from the actual new LRT line that'll be done by the time the building is done, which takes owners and residents directly to McMaster, but it does have a shuttle. And then the big reason, one of the big reasons I'm buying here is it's a 10% deposit structure. So this wasn't a thing before COVID. If you were buying pre-construction in a hot building, you're going to pay a 20-25% deposit structure. So I'm really taking advantage of this. And most of my real estate, I don't want to say most of my real estate, that's inaccurate, but I've purchased, I think, more units in the past 18 months than I have in the last 5 years combined. So while people are sitting on the sidelines, including resale buyers, that's all going to come back. All the demand's going to come back when rates start going down. You're going to see prices start to skyrocket. But right now is where you could actually see really good opportunities in the market. I'm not going to walk you guys through this. I really, really suggest reaching out to my team. I'll provide a contact info at the end of this. And that way they will be able to reach out to you and go through the financials. But just to show you my investment and take some information or take an example from Dion, the compound effect. So, based on my unit, 801,900 in 5 years, you see the gross, you see the increase in value every year, and then the compounded growth. But where you really start to see the magic is, in year 10. Now I'm looking at, my property's almost doubled. Year 15, you've got the Rule 72, which I really liked. I'm going to take from you. So, that's essentially doubled at 5%. And, in year 30, you're talking about millions of dollars, and adding $165,000 a year to your income. So, when we talk about making incredible wealth in real estate, we're not speculating on what tomorrow looks like and what today looks like. We're looking at a large amount of data, and we're forecasting what the future looks like. So, in this example, and this is my approach when I'm about to buy in a building, in a project, these are the numbers I look at. And this makes a lot of sense to me. The incentives make a lot of sense to me. And that's why I'm buying. Now, just to have fun, we added this slide because I love multi-generational wealth. And now that I've set up a trust and, it's really important to know that I don't have to sell property or even refinance property in 30 years because the cash flow coming from it is going to be so substantial. So you can preserve the capital. You don't actually have to sell real estate when you're doing it for a long term. And, this portfolio, if you were to buy 2 units today, you'd be putting down a down payment of $320,000. That's 20%. So you put down a little bit more for legal fees and, land transfer tax, but you're essentially putting down $320,000. In 20 years, you're going to have a portfolio worth 4.2. In 40 years, at 5% appreciation, you're going to have a portfolio worth $10 million. In 60 years, you're going to have a portfolio worth of $30 million. So, that's a long period of time. But, when you're looking at multi-generational wealth and depending on what your time frame is, it gets pretty exciting when you look at the compounding and the leverage. So, that was a lot. That was a long one. I hope you guys felt like you got a lot out of it. We're going to send out a copy of this. So we'll highlight different sections. Just to kind of take the key takeaways from here. Why now is the perfect time to invest? We've touched on this, but buy today at a discount or wait until prices go up. Most people will wait until prices go up, but right now is the opportunity. Follow the experts. It's heavily reduced closing costs, aggressive deposit structure incentives. That's exactly why I'm buying in here. Mortgage rates are down. Invest with less money and wait 4 to 6 years and take out a mortgage. We know mortgage rates are coming down. So that's what we're going to wait and do. Now, I can't see because I'm sharing my screen, but I think I've answered most of the questions. I'll just take this opportunity then to thank you guys. Sean, that was awesome. I'll see a lot of you, I think, over the next few days or few weeks. For those of you watching, we're going to be hosting an open house at the Corktown Presentation Center this weekend. We'll send out some information. I know we already have a few appointments booked, so we'll be there this weekend. Beautiful model suite. We'll be able to walk you guys through the project, book an appointment with my team at Condos at Connect, and we can walk you through the financials. Dion is available to talk to you about mortgages. I've got an appointment booked to Dion next week. He's going to take a look at my portfolio. Look, mortgage rates are high right now. I feel it as well. And I think it's a good time to talk to an expert to really see if there's anything they can do to help you out. If you're thinking about investing more, they can also give you some options as well. So, gentlemen, thank you very much for your time. It's been a pleasure, and we'll be in touch soon.
Good night.
Thank you so much.